Good afternoon, everyone, and thanks for joining us for today's webinar, SOC versus SOX. I'm Elaine Nissley, Principal and Leader of our Internal Audit Services group, along with Lynnanne Bocchi, Senior Manager and Leader in the SOC practice with the firm. For those of you who don't know, McKonly Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg. We provide a range of services to organizations across a variety of industries, as you can see on the screen, and we encourage you to visit our website to learn more.
If you've joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations as well as current information through our blog.
As we're going through the webinar, CPE polling questions will pop up on the screen. If you have any questions for us during today's presentation, please submit them through the built-in questions function of the webinar control panel, and we will do our best to answer them during or after the webinar. For those of you that are looking to obtain a CPE credit for today's webinar, please keep in mind that there will be 3 polling questions that need to be answered throughout the presentation. We actually have a total of 4, and of those you need to answer 3. Okay, so you have a picture here of myself. I'm Elaine Nissley, Principal with McKonly Asbury here in Central Pennsylvania. I have over 30 years of internal audit and internal controls experience, and I lead our internal audit practice. Our primary areas of emphasis include internal audit outsourcing services, Sarbanes-Oxley, and A123 compliance. And with me today is Lynnanne.
Hi, I'm Lynnanne Bocchi. I'm a Senior Manager in the SOC practice. And in addition to SOC reporting, we also specialize in doing HIPAA, cybersecurity and IT assessment services, and we are starting to advance into high trust reporting as well.
Okay. We already talked about that. Yeah, so as you can see, our firm covers a variety of industries as well as service areas, and we are looking forward to working with you today. Our first polling question is, do you wish to receive CPE for attending today's webinar? So it's an easy yes or no. And you, Henry, will be launching the polling question here shortly, right? The CPEs for today's webinar are 1 credit of audit for those of you who are looking for audit CPEs. So again, the polling question is up there, simply yes or no. And when we have looks like the polling question has ended, okay? Do we get the results to look at? Ah, there we go. 86% of you are looking for CPEs today, and we have 14% who joined us without even looking for CPEs. That's great. Okay, so next up, I want to talk about our learning objectives today. Our key areas are really giving you some basic knowledge and understanding of the Service Organization Controls Report, the SOC practice, and the Sarbanes-Oxley Internal Controls Assessment. We'll talk about how there's the interactions between SOC and SOX and how to gain efficiencies between the 2. Okay. And starting off today's session, Lynnanne will be going through some of the basic background information on system and organization controls.
Okay. And so if you advance, we actually have our second polling question, which is, does your organization obtain or use a SOC report? And the answers are, you use a SOC report to review service organizations, you obtain a SOC report to provide to your customers, you obtain and use SOC reports, no, but you want a SOC report to provide to clients, or just want the free CPE. All right, and that was nice and quick. And the majority of people just want the free CPE. I can't blame you, but the one after that is using a SOC to review your service organizations. A few people obtain SOCs, and then a few obtain and use. So, okay, so as Elaine said, we're going to give you a little bit of background on SOC and SOX before we talk about the similarities and differences, just to make sure that everyone knows what both of those are. So just the answer to some basic questions: who gets a SOC examination? And the answer is a service organization. But what is a service organization? Service organization is an entity that uses a service organization is the entity that's used to outsource certain aspects of a company's operations. And some examples of those would be if you outsource your payroll, your employee benefits, your claims processing, data centers are service organizations, cloud providers, IT managed service providers, and credit card processors. And there are many others. Those were just a few examples. And why do they need a SOC examination? That's to provide comfort to the user organizations about the processes and controls at the service organization. So the user organization is the customer or the client of the service organization. Who is going to be using the report? That would be the user organization's management and the user organization's auditors in some cases. And SOC 1 and SOC 2 reports are restricted to those who could be reasonably expected to understand the subject matter. And there actually is a statement right in our audit opinion that says that this is a restricted report and it's for management and their auditors. It's not a general purpose report.
But if they want a general report, service report, they can get a
SOC 3. Yes. So going into SOC 1. So SOC 1 examinations are focused on controls specifically related to ICFR or a specific financial statement assertion. And that's related to ICFR or the financial assertions for their customers, not for the service organization itself. They're doing this so that if their customers have a significant account or a significant assertion that relies on those external services being performed, that they can have confidence in the numbers they're receiving. Service organizations determine their control objectives and the controls to meet the appropriate objectives. Most of the time, those control objectives and controls are transactional in nature. So they're related to different financial statement transactions, and they deal with the completeness and accuracy of financial statement information. There may be a few IT general computer controls sprinkled into SOC 1s for things like system access, but that is not the main purpose of a SOC 1 report. So SOC 2 reports are used to ensure that the service organizations are maintaining controls to securely manage customer data and protect them and their privacy. For SOC 2, they are required to meet specified trust service criteria or principles defined by the AICPA. So there is a framework used for SOC 2s. The trust service principles assigned by the AICPA are security, availability, processing integrity, confidentiality, and privacy. And we will discuss on the next slide those in a little bit more detail. So the AICPA Trust Services Principles are used for both SOC 2 and SOC 3 engagements, and they give you prescribed control objectives or control criteria, they're usually called CCs, for the 5 trust service principles. Again, security, availability, processing integrity, confidentiality, and privacy. Now, these are not all required to be part of every SOC 2 or SOC 3 report. Security is the only required principle, and it's called the common principle or the common criteria for that reason. So service organizations receiving a SOC 2 select the trust services principle to be included in the examination. As I was just saying, they don't have to all be included, security has to be included, but then they can determine what other ones relate to their business and need to be included. A lot of times the principles that end up being included in a report are based on customer requests, or sometimes they are specified in customer contracts that they must receive a SOC with specified principles, or sometimes they just add principles above security for sales purposes so that they can tell customers whenever they're out there marketing. Now, they can't show them the report, but they can say that they meet availability or they meet privacy criteria as defined by the AICPA. And a service organization can exclude specific trust services criteria if it wants to or if it needs to, as long as they disclose it in the report along with the reason why that specific trust service criteria is not applicable. I will say that this is a pretty unusual circumstance because for most companies, there should be a way to apply every common criteria to an organization. There might be some unusual ways to do it, but I will say that for security, we do not have any clients right now who do not exclude or who do exclude any trust service criteria. They meet all of them. SOC 3. So this was established as a general use report. This is the report that can be used for marketing and that sometimes you will find posted on websites for companies. For example, I know AWS has both a SOC 2 and a SOC 3, and they post their SOC 3 on their website for everyone to be able to see. The SOC 2 is only distributed or available to their clients. SOC 3 examinations are examinations on controls relevant to the applicable trust services criteria. And this report only includes an auditor's opinion and a limited description of the controls. And pretty much what goes in that description is determined by the service organization. They can make it as robust or as minimal as they would like. The SOC 3 examination covers both design and operating effectiveness of controls for the applicable trust service principles, but it does not include any testing or results or specific controls. So if you're familiar with a SOC 2 report or even a SOC 1 report, there's usually a matrix in the report that lists all of the controls and the testing that was performed on them and the results of the testing. That is not part of a SOC 3. It does not go into that level of detail. I will say though, for a SOC 3, because it covers both design and operating effectiveness of the controls, we still have to do the testing on those. So I have not seen a situation where someone gets a SOC 3 without a SOC 2, because basically you're doing a SOC 2 to be able to get the information to perform the SOC 3. Let's see, so we have here the components of the SOC 1 and SOC 2 reports. The auditor's opinion, which I'm sure you're all familiar with, and then we also have a management assertion, which is pretty common. The third area is our description of controls or our narrative, and that is owned by management, and that is basically includes all the controls and gives an overview and details related to their organization. Complementary entity user controls, we will talk about those in a little more detail in a few slides. Then the matrices, which have the controls and the tests of controls. And then finally, other information. Other information is not a recurring section of SOC reports, so it may or may not be needed. What it goes in section 6, the other information, is either additional information from management that they want to provide to their customer, which is not covered by the controls earlier in the report, or more often the reason we insert it is so that management can respond to any exceptions noted in the report and talk about why they occurred and then the remediation that occurred with those. And section 6 is not audited either. It's not a covered part of the report. That is just management information. So you may or may not know, we have two types of SOC reports, a type 1 and a type 2. The type 1 is only talking about the design effectiveness of the controls. So we look at the control wording itself, making sure that it's properly designed. We do not look at how it operates. And a type 1 is also as of a date and time, a specific date. It does not have to be a period end. It could honestly be any date. A lot of times they are the end of a period, but they don't have to be. For type 2, that opinion covers the design and the operating effectiveness of controls. Type 2s are the major type of reports out there, which is basically a full report, and it's over a period of time, usually a minimum of 6 months. Can be up to a year. Some people are somewhere in between, 7 months, 9 months. Doesn't really matter as long as it's longer than 6 months. Okay, so for the narrative that goes in the report, which is owned by management, it's prepared by the service organization, it includes all of the controls, and then it is separated into the key components, which also line up with the criteria of the trust principle. So what's listed here, these first 9, excluding the overview, actually correspond to the security principle. So control environment is common criteria 1, information and communication is common criteria 2, etc., right down through 9. Those all cover the security principle. Obviously, there are additional ones if you add availability, confidentiality, processing integrity, or privacy. Complementary user entity controls. So these are controls, it's a separate section in the report, and they're controls that are identified by the service organization that need to be in place at the user organization in order for the service organization controls to work effectively. And I know I just said the word organization a bunch of times. So basically what these controls are is saying to the customer, you need to have these certain controls in place at your company in order for us, the service organization's controls, to work effectively. An example of that is if you, as the service organization, have software as a service and your customer has access to that software, you could have a user entity control that says if the access changes, they need to notify you. So if they have a termination and they don't notify you that that individual should no longer have access to the software and something happens, that's on the customer. That's not on you, because that's something that's out of your control. So basically what these user entity controls are doing is limiting the liability of the service organization should the customer not have specific controls in place. So this is something that when you receive your SOC report is very important to review. Make sure that your company has these in place if they are applicable. Okay. Control activities and tests of controls. So we have control objectives for a SOC 1 or trust services criteria for a SOC 2. And we have the controls needed to meet either the control objectives or the criteria. Tests are performed by the auditor, and then the results of those tests, there can be one of three conclusions that come out of the test. The first one is just an exception occurs. And how that's noted in the report is right in the matrix area of the report. We will say that we always give a number. We'll say, you know, this number out of this number in our sample. So, you know, maybe 1 out of 3 did not occur during the period. And an example would be if there was a control requiring security training for all new hires, and you picked 5 new hires and one of them for some reason did not receive the security training. There would be a comment in there that says 1 out of 5 new hires did not attend security training. So that's how that's communicated. We could have control objectives not being met. The reason this would happen is because there are not enough passing controls to thoroughly cover the control objective or the criteria that it's trying to cover. We also have controls not operating during the period. That means the control didn't operate at all. And an example of that is if you have, let me go back to the new hire control again. If you say all new hires have to have security training and you had no new hires during the period, that would be a control that did not operate during the period. So that also would be noted in that section 5 of the report. Not having the control objectives being met or having controls not operating during the period, depending on how many there are, could lead to a qualified opinion if there aren't enough mitigating controls to thoroughly cover the control objective or the criteria. Exceptions and control failures. So any exceptions identified during the testing are required to be reported. And I just gave you an example on the previous slide of how that happens. We give the sample, the size of the sample, along with the number of items that were exceptions. And then in the event of substantial exceptions, if the service organization does not have sufficient mitigating controls, the auditor's opinion may need to be modified. And again, that would be a qualified report. So we have 3 methods for testing SOC controls. Inquiry, which is done for every control, cannot be performed alone. You have to use one of the other 2 along with it, which is observation or examination, or inspection is another word for examination that's used sometimes. So walkthroughs of controls are performed for every single control. That's the inquiry portion. And then sampling, which is done through either observation or examination, is based on the frequency of the control activity and the reporting period. And we have guidelines through the AICPA as far as sampling goes. User considerations for SOC reports. So when you're reviewing a SOC report, a couple areas that are important to keep in mind is, first of all, evaluating the specific area or process that the SOC report is being provided for. Make sure that it is the area that you're auditing. SOC reports are limited in scope. They do not cover the entire organization and every function or business process that goes on at the organization. So first of all, make sure that the scope covers what you're auditing or what service you're receiving. Review the auditor's opinion for any modifications or qualifications to the report. And then review the controls and the tests of controls, specifically for control objectives directly related to your ICFR or specifically related to the services you're provided. Also, keep an eye out for any exceptions and make sure that they do not impact the services that you're receiving. And then the final item is reviewing those complementary entity user controls that we talked about earlier. Make sure that you have them in place, or if they're not, could be they're not applicable. Sometimes they are not, but at least do the review to make sure that if they are applicable, you have them in place.
Okay. Anything final on SOC?
Nope. I think we're pulling question number 3.
Okay. And polling question number 3, we're moving into our SOX area now. And within your organization, is SOX implemented? Are you currently implementing SOX? Are you considering implementing SOX? Or SOX is not applicable to your organization? Or maybe, again, you just want the free CPE. Okay, looks like 31% have SOX implemented, 35% the SOX is not applicable to their organization, and now we've jumped up to 28% of people that want free CPE. And so we'll move on to our SOX part of the presentation. Let's see if I can't, there we go. Okay. So Sarbanes-Oxley, of course, is a regulatory compliance issue, and it deals with internal control over financial reporting. And the objective is to improve the accuracy of financial reports, their reliability, the completeness and accuracy of disclosures, and we want to protect both the investors and the employees' interest from fraudulent reporting and types of corporate scandals, and in some cases even the demise of the organization. Now the regulation, a lot of people just think of Section 404 and the internal control over financial reporting, but Sarbanes-Oxley is larger than that. Section 302 talks about quarterly certification. The CEO and the CFO need to quarterly and annually certify the financial reports and certify that they're accurate and reliable. And the signing officers certify not only the company's internal controls on the business side, but also the IT controls. And they generally also look throughout the organization for the people reporting to the CFO and CEO to certify for the controls that they own. So again, there's penalties associated with false certifications. Section 401 requires the financial information for the public, and any reports provided to the SEC will not contain any untrue statements or omission of material facts, that they'll comply with GAAP, and the reports will include all material off-balance sheet transactions. The importance of the financial statement auditor is highlighted in this section because the financial statements need to comply with GAAP. And also the CEO and CFO in combination with the financial statement auditors need to review any off-balance sheet transactions and verify that any off-balance sheet transactions are included in the financial statements. And if those you can recall back prior to 2004 and SOX, Enron was the organization that went belly up because of all the off-sheet financial transactions. In Section 409, issuers are required to disclose to the public on an urgent basis information on material changes in their financial condition or operations. These disclosures are to be presented in terms that are easy to understand and supported by trend and qualitative information of graphic presentations as appropriate. Section 409 highlights the importance of having a disclosure committee who has accountability to work with the financial statement auditors to make sure that all disclosures will be understood by the average investor, including any necessary trend and qualitative information to support and make clear the disclosure information. As the CEO and CFO review and sign off on the financial statements, they need to pay attention to the completeness of disclosures and make sure they include any material changes in the organization's financial condition. And then we have Section 802, which can impose up to penalties of up to 20 years in jail for altering, destroying, or concealing records or documents that are relevant to a legal investigation. An accountant or auditor who knowingly and willfully violates the requirements to maintain records for 5 years can be subject up to 10 years in jail. The CEO and CFO are not the only people being held accountable for the financial statements. Any accountant or auditor, both public and internal, must maintain their records for at least 5 years. The other thing to keep in mind is that these records may be subject to legal investigation. Any discrepancy between the supporting records and the financial statement may come out in this investigation and may open up the avenue for allegations of fraud or cover-up. And Section 806, commonly called the whistleblower section, it provides whistleblower protection for employees. An employee is engaged in protected whistleblower conduct if they suspect and report federal mail, wire, bank, or securities fraud, a violation of federal law relating to fraud against shareholders, and or a violation of any rule or regulation of the Securities and Exchange Commission. The protections apply to employees and contractors of publicly traded companies or their subsidiaries, as well as someone with a nationally recognized statistical rating organization. Under this section, someone who retaliates against a whistleblower can be subject to criminal charges. In Section 806, the organization should have controls to provide avenues for anonymous reporting of suspected wrongdoings. It is recommended that the audit committee or board have oversight of this reporting. Frequently, the audit committee will receive all of the reports that come through the hotline so that there is independent notification. Not only should the organization have ways for anonymous reporting, they also need to have strong policies and controls to make sure that there is no retaliation against individuals who report suspected wrongdoing and encourage an environment of openness and trust. In Section 902, it says that an executive who violates SOX in a fraudulent manner will be subject to the usual penalties, whether fines or jail time or fraud. In my early days doing SOX implementations for organizations, I always requested that the CEO address the key control owners to impress upon them the importance of SOX compliance. I will always remember the CEO who addressed his management staff and told them that he did not like to wear stripes or orange, and he was depending upon them to make sure that that did not happen. In Section 906, it provides for penalties up to $5 million and 20 years in jail for certifying a false or misleading report. The CEO and CFO of the company must provide a written statement that shall certify that the periodic report containing the financial statements fully complies with the requirements of Section 13A and 15D of the Securities Exchange Act of 1934. Section 906 requires the CEO and CFO to provide written certifications and imposes further penalties for false or misleading certification. Could your organization survive a scandal and financial losses if the CEO and CFO were indicted? And now the big section that everyone always talks about is Section 404. And that's the SOX compliance audit requirements. Companies are required to include the following information in their annual filing: a statement of the responsibility management has to establish and maintain adequate financial reporting controls, a statement of how management evaluated the effectiveness of the company's internal controls, a statement from management with an assessment of the effectiveness of the internal controls, and a statement from the external auditor attesting to management's assessment. I've left Section 404 to the end. This is a section that causes all the expenses and pain to implement in preparation for an IPO. The assessment of internal controls over financial reporting is not a task that can just be absorbed into day-to-day operations. The implementation of SOX requires careful planning and dedicated resources. The initial implementation is typically a very heavy lift and requires outside knowledgeable resources for a successful implementation. Now, one of the commonalities between SOX and SOC is that they both use the COSO framework as their basis. So the Commission on Sponsoring Organizations framework for internal controls is the basis for ICFR for SOX. It's also the basis for ICFR for SOC 1. And it's the basis for the SOC 2 trust services, at least the first five, yes. Okay. So the COSO framework is comprised of 5 components: control environment, risk assessment, control activities, information and communication, and monitoring. And those same 5 components were covered by Lynnanne when she looked at the trust services principles. Within the 5 components, there's 17 principles, and we're going to cover these principles in detail. It's important to note that the rule of judgment plays an important part in designing, implementing, and conducting the assessment of internal controls. It also is very important when you're assessing the effectiveness of the internal controls. An organization needs to apply a risk-based approach to design and implement a system of internal control over financial reporting, which provides reasonable assurance and is not prohibitive in cost. The COSO framework is very broad and applies to all of the entity's objectives. In this discussion, we will concentrate on the objective of completeness and accuracy of financial reporting, or the internal control over financial reporting. The internal controls must cover business and financial processes that have material impacts on the financial statements, and also information technology controls over systems that support the business and financial processes that have a material impact on the financial statements. When you look at the COSO framework, you start out with the control environment. And the overarching control environment needs to be an ethical business culture which is driven from the top of the organization. The board of directors and management at all levels of the entity need to demonstrate through their directives, actions, and behavior the importance of integrity and ethical values to supporting the function of the organization. And there needs to be independent oversight. The board of directors identifies and accepts its oversight responsibilities as far as establishing requirements and expectations. The board of directors defines, maintains, and periodically evaluates the skills and expertise needed among its members to enable them to ask probing questions of senior management and take commensurate action. The board of directors needs to have sufficient members who are independent from management and objective in the evaluation and decision making. So the board of directors retains oversight responsibility for management's design, implementation, and conduct of internal controls. So one of the things that the Sarbanes-Oxley Act did was put much more accountability and responsibility back on the board of directors. No longer is sitting on a board just an easy retirement job. There are tremendous accountabilities and responsibilities associated with board members for publicly traded companies. Okay, and then management and the board are both responsible for developing and maintaining a structure throughout the organization to support the achievement of their direct objectives. And again, one of the key objectives with the control over financial reporting is adequate segregation of duties. So the organization needs to be structured in such a way that there is accountability across the silos within the organization. One of the areas I guess we run into often with our SOX is the lack of documentation. And Sarbanes-Oxley really wants to see policies and procedures that are documented. And from my perspective, when you have a documented policy and procedure, that makes my life a lot easier because I have a solid basis that the organization said, this is what I want in place with the organization, and we can audit against that baseline. So again, policies and procedures are very important. And that includes also the policies and procedures relative to attracting, developing, and retaining competent individuals. Without the right people and the right seats in the bus within the organization, if they don't have the skills to accurately and efficiently perform their jobs, your system of internal controls is most likely not going to be working very well. So again, the competence and level of the skills of the employees is very important. And in addition, not only do you need to have competent employees, but they need to actually accept ownership of their internal control responsibilities and be held accountable. And if they fail in their internal control responsibilities, then there needs to be policies and procedures in place to take action. Okay. For the risk assessment, we'll just look at risk assessment within the scope of external financial reporting. Financial reporting objectives are need to be consistent with the accounting principles suitable and available for that entity. The accounting principles selected need to be appropriate to the circumstances, and management needs to consider the materiality within the financial statement presentation. External reporting needs to reflect the underlying transactions and events to show qualitative characteristics and assertions. The organization needs to identify and assess risk to the entities, subsidiaries, division, operating level, and functional level. So the risk is not just a high overarching corporate level item. It needs to be drilled down through the entire organization. And they need to put in place risk mitigating controls at all levels within the organization. And the risk assessment needs to consider how the risk is managed. And when you're managing a risk, that doesn't mean you need to spend a lot of money on a extensive system of internal control. You can decide that the risk is not great enough to spend money on controls, and you can accept that risk. Or you can avoid the risk by maybe offloading a portion of that, so outsourcing a portion of the operation and transferring the risk to your third party. You can reduce the risk, and again, that's building your system of internal controls. You can also share the risk. So an example of sharing risk is by purchasing insurance to help mitigate the cost of a particular risk. The assessment of fraud really, in this case, considers fraudulent reporting, the possible loss of assets, and corruption resulting from various means of fraud and misconduct. The assessment of fraud risk considers the incentives and pressures that would incentivize someone to perpetuate fraud. The assessment of fraud considers opportunities for unauthorized acquisition, use, or disposal of assets, altering of the entity's reporting records, or committing other inappropriate acts. The assessment of fraud risk considers how management and other personnel might engage in or justify inappropriate actions. And then the, Principle 9 under risk assessment is the risk identification process, and you need to consider regulatory, economic, and the physical environmental impacts. The organization considers the potential impacts of new business lines. Going into a new line of business is always a higher risk area for the organization. Or you need to look at dramatically altered compositions of existing business lines. And I think We had a tremendous amount of that as we went through the pandemic and 2020, 2021. Organizations were dealing with tremendous changes in business operations. Other areas of risk include rapid growth, changing reliance on foreign entities, and new technology. The organization needs to consider changes in management and respective attitude and philosophies of management on the system of internal controls. I think we're getting close to the end, aren't we? Okay. Yeah. The control activities include areas of business and technology processes, as well as policies and procedures that support ICFR. Control activities help to ensure that risk responses that address and mitigate risk are carried out. Management needs to consider the environment, complexity, nature, and scope of its operations, as well as the specific characteristics of the organization. It's important that there are clear policies and procedures that guide the implementation of the ICFR controls. And these include items such as defined approval levels and clear accountability for review of the preparation of documents and transactions. And this area is probably one of the areas where you'll have the largest number of business controls. And then Principle 11 also deals with your information technology controls as well. Information and communication principles are the areas of communication that should be considered, including communication to external parties, enabling inbound communications, communication with the board of directors, and communication within the organization. So again, when you're looking at the information and communication, it's not just what happens within the individuals within the organization, but you need to look at all areas and types of communication. And the monitoring activities, management needs to balance the ongoing and the separate evaluations. They need to consider the rate of change in business and business processes when selecting and developing ongoing and separate evaluations. And the management and board of directors needs to assess the results of the ongoing and separate evaluations, and deficiencies are communicated to partners responsible to take corrective action. So again, communication and exposure is very, very important within the monitoring activities. Generally, most organizations will have a set of management who has accountability for SOX ICFR that keeps in close touch with what's happening as far as the design and operation of the internal controls. And then that committee typically will report to the board of directors, or at least the audit committee of the board of directors. So again, your business controls concentrate primarily on the accuracy of the information that fed into the financial reporting and the impact in part or whole. So in other words, is the impact really material? And then you need to look at it from a risk-based perspective and only spend time and money on those areas where there would be a material impact on the financial statements. Again, financial reporting, I don't know any organization that does not rely on technology in some means or fashion in order to produce their financial reports. So this becomes a very important area where you need to not only look at the controls within the applications that you're using, but also the controls within IT related to how changes are applied to those applications, how you have access to those applications, and of course the big word is cybersecurity risk and somebody getting in and touching and manipulating your data. COBIT, we won't go into that, we're running out of time here, but COBIT is a framework that's frequently used for the IT controls. And there are mappings out there where you can actually map the COSO control objectives both to the trust services criteria and to COBIT. They all interrelate. So now we're on to polling question number 4. Are you interested in SOX or SOX? Interested in learning more about SOX or SOC or both SOC and SOX, or just want your free CPE again? Okay, we jumped up to 56% in free CPE, but we do have a few people that have an interest in learning more, and certainly Lynnanne or I would love to talk with you.
Definitely.
Yes. Okay, and now we're going to cover some SOC and SOX commonalities.
Yes, the moment you've all been waiting for. So I'm going to go over the differences, and then Elaine will cover the similarities. So here are just a few. For SOC purposes, we have complementary entity user controls, which, as I explained to you, are controls that the customer, the person reading the report, needs to have in place. There are no such complementary entity user controls for SOX. SOC is not regulatory. It's based on either what our client is looking for in the report or what their customers may be looking for in the report. Whereas SOX is an SEC requirement for all publicly traded companies, only publicly traded companies. SOC falls under the AICPA as far as SOC 2 and SOC 3 go, and SOX falls under the AICPA and the PCAOB. We have an auditor opinion in our SOC reports. It is considered an audit report, and for SOX, there is a management assessment. SOC covers a period of time. It can also just cover a specific date if it's a SOC 1, but a period of time, whereas SOX is specifically reporting on controls at the end of a fiscal period.
Which means that you can remediate and test and have a control marked as working even though it wasn't working when you initially tested it within SOX.
Yes, that's the biggest difference. For SOC, since it's not as of the end of a fiscal period, if you have a failure, the failure is noted in the report, even if it is remediated during the time period of the report. And testing for SOC, we use inquiry, observation, and examination. And SOX uses those same 3, but then also adds in reperformance controls if necessary.
Now, our similarities, I did touch on the fact that the COSO framework applies across the SOX 5 trust services criteria and frequently is applied within the SOC 1 as well. Both reviews include control walkthroughs. They test the design effectiveness of the report and of the controls. And then within a type 2 report for SOC, they test the operating effectiveness, and SOX always tests the operating effectiveness. These samples that are pulled and tested are based upon the frequency of the control. And the controls can rely on the work of internal audit and use similar assessment criteria. So again, controls that are documented for a SOC 2 report, for example, could also be used as a SOC report. And depending upon whether or not it's an external entity, if it's a service organization, then you just rely totally upon the SOC report, a SOC 1 or a SOC 2. And as I indicated, the control objectives map across COSO, the Trust Services Principles, and COBIT. Pardon? Do we have the last?
Yeah, you want me to do it?
Pardon?
I'll do it. So thank you for joining us for today's webinar. If you have any further questions regarding today's presentation, please feel free to reach out to either Elaine or myself. We'd be happy to assist you. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. Registration is now open for our upcoming annual leadership conference, Collaborate.
Is it still open?
Which it is getting very full.
Yes.
So if you'd like to register, please do so soon. But we are featuring former Penn State football captain and human resource executive Lee Rubin, as well as noted economist Dr. Anirban Basu. Collaborate offers several types of continuing education credits, including CPE, PACLE, and SHRM. Collaborate is an all-day conference scheduled for Thursday, May 18th, and it is located at the Penn Harris Hotel in Camp Hill. Please visit our website to learn more. So thank you everyone for joining us, and enjoy the rest of your day.